Good morning. Bruce Robbie here, Relevant Wealth, checking in today. There's a lot going on in the world, and so I thought it would be helpful to just reach out to all of our clients with a short video, just providing some context as to what's going on, what's happened this year, and what the rest of the year could look like for us. So I've prepared a short presentation, and of course, if you have any questions, please reach out to us anytime. We're always available and eager to meet with you one-on-one or talk about any of these issues with you in more detail. I just thought reaching out with a video would be a great way to share some information and also answer any questions. So let's just kick off the day with some good news. So, there are good things going on in the world, and this presentation is really focusing on how the changing dynamics of the world landscape impact our investments. And so that's really the focus of this conversation, what we're doing around our current investments and changes we're making in light of all the changes we're feeling. So let's start off with some good news. Of course, we have diversified portfolios. Typically, our clients have 5 different asset classes. Those are detailed in your investment policy statements and also show up in all the reporting we provide you. The good news is 4 of our 5 asset classes this year are performing quite well. The other good news is U.S. equity portfolio, which is really the portfolio under the most stress this year, is only down not even, let's say, 4% this year. So we think of that as actually kind of a win, considering we're a third of the way through the year, and it's been, let's just say, volatile. So all in all, let's just say up to today, our portfolios are holding up amazingly well, and we're very proud of that. And I think it's always good to appreciate what's working. I want to talk about the U.S. economy for a minute because it's in the news. We just heard Q1 GDP for the year was down 0.3%. I'm going to dive into that in just a minute, but I want to just show you this chart here showing our U.S. economy and how resilient it really is. And this is going back to 2020, so it's about 25 years of history. And GDP is, by definition, the goods and services produced by labor and property located in the United States. So this is the size of our economy. And this line shows you the inflation-adjusted growth of our economy. So even after inflation, our economy really has never been bigger. In fact, you can see on the right here, we had a little tiny little blip right there. But basically, you can see the last 3 recessions, the financial crisis, how painful that was. We all remember that. I know I do. We have the COVID crisis, and our economy has recovered time and time again with steady growth. And in fact, since COVID, our economy has been growing at really a very attractive rate. So let's not forget, our economy has never been stronger. Unemployment is relatively low. Inflation right now is come down quite a bit, as we know. And so there's a lot to feel good about. Just in case you forgot or didn't participate in macroeconomics in college, I just want to talk about GDP because it's going to be in the news a lot this year. And I just want to remind everybody what makes up our gross domestic product. And it's a combination of really 4 things. Consumer spending, which is the biggest component by far, about almost 70%. Business investments, government spending, and net exports. And generally, we are a net importer, as you may know. We import more than we export. And so exports actually take away from our GDP growth, net exports. And why is that important? Well, I just want to point out here, if you look at this chart that details what happened the last quarter and how we got to that minus GDP number, because you may know if we have 2 quarters of negative GDP, well, that's technically a recession. So we just had the first quarter minus 0.3, pretty small number, but still minus. But I want to just look here, dive in here and look at what drove that. And what happened in the first quarter is we had massive imports in the first quarter in anticipation of increased tariffs. So we imported a tremendous amount of products that we normally wouldn't, and that's a negative on the GDP calculation. So imports soared actually 41.3%. which, over the prior quarter, which is tremendous. You can see here imports the quarter before relatively small, and then anticipating increased costs on imports, most businesses in the United States really accelerated their imports, and that is a headwind for the GDP calculation. So it's just a fact. It's part of the calculation. It is what it is, and we'll talk about that in more detail, of course. So far, so good. You know, it's honestly, I think we all feel a little anxious about what's happening, and that's normal and fair enough. But so far, so good as it relates to our investment portfolios, our strategies, our diversification. Everything is really doing the job we expect it to have. Now I want to talk about the rest of the year and 2026, because I think, of course, there's a lot going on that we haven't really fully felt. So I think we are going to have some headwinds this year, and that shouldn't be a surprise. And I want to just explain, you know, what might be behind that, what we're doing around that, and how our portfolios should mitigate this as much as possible. I really want to just talk about one issue that I think is the most relevant as it relates to our economy and also our investments, and that's global trade. And global trade is such an important part of global commerce. As we know, we buy things from all over the world. It's something that has been growing and growing over our lifetimes, and it's an essential part of commerce and what makes our economy so dynamic and keeps our costs down. Most U.S. companies make products overseas. They make them here. They incorporate parts from all over the world, and this is happening with other countries as well. And it's really kind of the backbone of global trade. And of course, with these new tariffs that are being implemented in the United States, it really questions like, how is that going to affect global trade? And that's a big question mark. But it is probably the biggest issue for the year and something we're watching very closely. So when we have trade disruption, there's really four things I want us to think about. Increased inflation. Now, if we have tariffs that are sustainable, well, that increased costs, and it may be material, and it may not be, but that does increase costs, and that adds to inflation. Now, inflation has come way down. We also want to be aware of that, but this could be a headwind for inflation. Well, of course, if trade decreases, spending decreases, we could have increased unemployment. That's a problem. Unemployment's very low. We want to keep it that way. We've seen some layoffs in the federal government. But overall, we want to make sure our unemployment rate stays low, people stay employed. The economy could just slow down. As I noted, you know, our economy is driven by consumer spending, and that's the biggest component. And if consumers cut back on their spending, that slows down our economy. And all three of those issues have significant effect on the stock market and the volatility of the stock market, more so than the other asset classes. So let's just look at some charts. I think charts are helpful. It gives us a chance. Let me zoom in. Charts. This is a chart showing expected inflation from a couple of surveys. And you can see here on the far right, inflation, you know, expected inflation has been coming down, but we've seen a dramatic increase in consumer sentiment as it relates to their expectations for inflation. So people feel like things are going to get more expensive. Now, that doesn't mean it's going to get expensive, but that's the feeling, and that's really important because it does affect consumer spending. So there is an expectation that we're going to have more inflation. If we look at the jobs market, and there's a lot of data on this chart, but I would just want to point to the right side of the charts here. And the first one is the jobless claims, and they're pretty stable. And in fact, continuing claims, we have initial jobless claims at the top, and then we have continuing claims at the bottom. And we have a very stable labor market today. So that's really great that we have these stable markets. People are working, there are jobs that are available. Some people have lost jobs, but there are plenty of job openings still. So as we go into the balance of the year, we're in pretty good condition to absorb any sort of economic slowdown. Now, announced job layoffs are something we can look at, and you can see here there's something pretty dramatic happening here. During COVID, we saw significant announcements of job layoffs, and we've seen it again, mostly, you know, at the federal government level. So unclear as to how many jobs will be lost, but there have been, as we know, a lot of job layoff announcements at the federal government level. If we take the government out, you can see the red line, actually, the jobs market's pretty stable. So a lot of rhetoric about people losing their jobs. It actually hasn't happened yet, but it's something we really want to keep an eye on, because that's an essential part of what makes our economy so stable and robust. So I want to come back to this chart around the GDP, and one of the headwinds I think we see here is consumer spending being the biggest part of our economy. Last quarter was only up 1.8%. You can see this little orange box here. Now it's still up, so consumers are spending more in the first quarter than they have been. That's great, but normally consumer spending is growing at, say, 2 or 3%, or maybe even higher. You can see the prior quarter, the orange box here. So consumer spending is slowing down, the growth of it. Still spending a little more, but that's something we want to watch carefully, and we're going to keep an eye on, because the consumers in the United States are the backbone of our GDP. So now, that being said, we know that that all of these headwinds we're facing are lowering expectations, but still the GDP growth forecast for 2025 for the United States is still positive, 1.8%. It's not 2.7% anymore. This was from about 2 weeks ago. So there is a chance of a recession, and we don't know how important that's going to be, frankly, or how long, but it's something that the odds have gone up quite a bit. So, of course, as things slow down, the economy slows down, there is a possibility that we experience a recession, but again, we haven't seen that yet. Well, market volatility, this is the fourth leg of what we're experiencing, and this chart I think is really interesting. It just shows you the stock market since the beginning of 2023, and we had this phenomenal run-up of the stock market up to like 60% in 2 years, which is phenomenal. And then you can see on the right here, 2025 has been pretty unusual as far as volatility, and we had a big correction in the early part of the year. In the last 2.5 weeks, frankly, the market's come up considerably, as we saw year to date, only down about 4%. So we're expecting more market volatility this year, and it's just a fact that there's a lot going on. There's a lot going on in the world. There's a lot of change, and change is really hard to forecast, particularly when the change keeps changing. So let's just get comfortable with that and know that the financial markets are robust and dynamic, and they will adjust accordingly. But this year has been a little crazy as it relates to the U.S. stock market volatility. I think we all know that. We hear about that on the news all the time, maybe too often. One other thing that's happening in the background you may not be aware of is, the value of the dollar relative to other currencies is really important. A strong dollar means when we go out and buy things, we can buy more, the same thing. And a weak dollar means it costs more dollars to buy the same products overseas. And in fact, we've seen a pretty substantial decrease in the strength of the dollar, about almost 9% weakness year to date. This is through April. So that means even without tariffs, when we import things, they're going to cost about 9% more than they did last year. So that's a headwind on trade. Now, the dollar gets stronger and weaker across currencies all the time. This chart just shows you kind of an overall relative value of the dollar to other currencies. And you can see the dollar gets strong, it gets weak, it gets strong, it gets weak. And it's certainly, on the far right, you can see it's weaker than it was, let's say, at the beginning of the year, but it's in kind of this range. So I don't know that we want to get overly excited about that. There's been a lot of conversation around that. But the value of the dollar is really important. We want to have a stable dollar for all kinds of reasons. Okay, what does this all mean? I mean, I think at the end of the day, hopefully none of that was overly surprising, but what does this mean for us for the balance of the year, and what are we doing? So I think we're going to just wrap up with a few points. Now, first of all, there is a scenario, and just in case you've heard this term stagflation, where the economy slows down, but we also have increasing inflation, and that's just called stagflation. So it's not where we want to be. It's not a good economic environment. Things are getting more expensive, and the economy is shrinking, and those kind of feed on each other. And sometimes it's difficult to unwind that. So if you hear the term stagflation, just know it means the economy is slowing down and inflation is going up. Is it likely? Hard to say that it's likely, but the probability is certainly going up with tariffs, particularly if they continue to be at the levels they're at. Now, one of the tools that we have available to us is the Federal Reserve controls short-term interest rates. And of course, if they see the economy slowing down, they're likely going to lower interest rates. And in fact, the markets are expecting a number of interest rate decreases this year from the Federal Reserve. So when they do that, that will act as a cushion to offset any economic weakness, and that's positive. So that's one tool we'll see our government use at the right time. Now, the Fed's meeting today. More than likely, they're not going to lower rates today. But the expectation is that over the course of this year, we're going to see short-term rates come down, and that has all kinds of benefits. Now, what are we doing? Now, let's just not forget that we have an investment policy for each of you, and that's really the backbone of anticipating market volatility. So we have different asset classes, typically U.S. equities, international equities, fixed income securities, alternative investments, and then, of course, we keep cash and money market available for you when you need it. So we have an intentionally designed a portfolio of asset classes that are not all correlated and have different risk and return profiles. And by combining these over time, we can grow and protect your wealth. So you get a report every quarter with those targets. Most of our clients have U.S. equities as their largest asset class. And so that's a conversation. We know that's going to be the more volatile portfolio this year. And so we're available, of course, to talk about changing that, amending it. Frankly, you can look at your portfolio reports. Our portfolios in total are holding up amazingly well. But so that IPS, an investment policy statement, is designed to weather these blips that are usually impossible to forecast and very difficult to understand how they're actually going to play out over time. So what else are we doing? So now the U.S. portfolio is down a little bit. Typically, we rebalance. So if you're supposed to be at, say, 45% U.S. equities and it drops down to 42%, then we usually top that off and bring it back up to 45. Now, right at the moment, we haven't done that. We're just waiting a little while to see how assets stabilize in the next couple months. So we're probably a little underweight our target for U.S. equities. So that's one of the things we're doing. That's our riskiest asset class. It's the one under the most stress. So we're a little underweight there. And then also we're trying to, within each asset class, focus on investments that have lower volatility inside each asset class. And as an example, I just wanted to point out, you may have seen some trading activity in the last few days in your portfolio. And one of the things we did in the U.S. equity portfolio, as we moved out of the Janus Henderson 40 fund, which has been a phenomenal large cap growth fund, but growth funds can be more volatile when the economy is volatile. So we've taken that position out of the portfolio, and we've taken those proceeds and reallocated them to two less volatile strategies. Still very attractive. We have a value fund from Federated, and we also have a quality fund from Invesco. And so we've just taken that 14% and split it. And so that increased our value fund from 7 to 14% and our Invesco fund to about 30%. And, well, that should add up to 100. But the bottom line is inside each asset class, we are trying to hunker down a little bit. And so this is one of the things we just did. And if you want more details on that, please reach out. We're happy to kind of dive into that in more detail and show you how it works. Now, of course, we're also notice that we are entirely focused on large cap U.S. equities. And I think this is also another great way to mitigate market volatility. Large cap, these are the biggest companies in our U.S. economy, and we have found time and time again that the larger companies tend to hold up better when markets are more volatile. So some final takeaways. So, April's behind us. We're about a third of the way through the year. The tariff announcements are concerning. We don't know what it's really going to mean. The U.S. stock market has actually bounced back significantly. We have yet to see the full impact, frankly, of this initiative, and the probability of a recession and maybe stagflation has gone way up since the beginning of the year. Doesn't mean it's going to happen, but it's becoming more and more likely. And if so, it's not the end of the world. We saw, even with the financial crisis, how quickly the markets recovered in the economy. And now corporate earnings are strong, but the operating environment has changed dramatically. So we're still expecting corporate earnings to grow this year, maybe at half the rate we expected at the beginning of the year. But overall, corporations struggle to plan when there's a lot of uncertainty in policy. So we're going to have to sit through that and be patient. So just a final takeaway here. Warren Buffett just announced his retirement this week, and so I thought it'd be worthwhile to throw a Warren Buffett quote up. The most important quality for an investor is temperament, not intellect. Well, let's hope you have a combination of both. But when times are really stressful, as they are now, I think it's great to remind ourselves that we have long-term investment plans. Our time horizon is long-term. We have a diversified asset allocation. And all three of those criteria are helpful in mitigating the volatility of the short term. And that's the ultimate goal of our investment strategies, to anticipate that volatility is going to show up. And when it does, our portfolio diversification should be of tremendous value. So that's kind of where I wanted to wrap up our conversation. Let me just say, we're here all the time. My team and I, we come to work every day. We love working in the office. In fact, we're planning an expansion in the office later this year. So we're here to talk to you. If you want to get together via Zoom, in person, or on the phone, or via email, please call us. Call me anytime. This is really important for us that we stay in touch with you, make sure you understand what's going on. If you feel like we should make a change in your investment policy, well, let's talk about that. If you have significant expenses you expect this year or early next year, well, let's just plan to make those proceeds available now, so that we don't have to worry about what's going to happen in the future. So I hope this has been helpful, and please, as I said, call us anytime. We'd love to hear from you. Have a wonderful week. Take care.